Hey, thanks for staying with us here on the Savvy Investor radio show and podcast, here with Mike Canet of Pro Status. Local for you. Offices in North Bethesda, Towson, and Hanover, ready to help you to and through retirement. Mike is a financial planner and estate planning attorney with a master's degree in tax and 4-time Amazon best-selling author. If you are watching us on YouTube, the book behind me over there is Nothing is Certain But Death and Taxes. And that's the one thing that we can count on. Or two things rather, is death and taxes until now.
But you know what? You don't get to control one, but you can control the other, right? So the death you really can't say no to, because that's going to happen. But the taxes, you do have an option there.
But see, when you say that, people think, nah, man, there's no way. But
I don't want to go to jail. He's full of
yeah. I want you to explain that in the most tax efficient way legally possible.
Well, let's talk about RMDs, right? So we have these things called required minimum distributions. Mm-hmm. And if you think about this, when you were younger and you started saving for retirement, and you were doing it through your company sponsor plan, maybe you were doing it on your own through an IRA or something like that. You were told how important it is to save money for your retirement. And I think we all intuitively understood that, right? We understood we had to put money away and we put it away at various amounts. And typically we saved more from age 50 to age 60 or 70 than we did from 30 to 50. And that just happens to do with the demographics of raising kids and all that type of stuff. But what wasn't clearly explained to us, somebody said, put money in a 401k, put money in an IRA, because when you retire, you're going to be in a lesser tax bracket, right? So by putting money into these retirement accounts today, we give you a tax break. That's the incentive that Uncle Sam makes to you, right? Uncle Sam says, and in the States, if you're paying tax, like in Maryland, they say, look, we're going to give you a tax break for putting money into a retirement account. Now, you didn't read the small print, because what the small print said is, we're going to give you a tax break today, but we will be your partner in that 401k, in that TSP, in that 403b, in that retirement account. We are going to be your partner for the rest of your life. So every day you take a penny out of that, we want our cut, right? We want our 1/3. We want our 20 to 30%, 40% taxes.
So that's why that print is so small.
That's why it's so small, right? I mean, as a matter of fact, you just kind of breeze over. You probably didn't even notice it on the applications when you're filling them out. So we were told how important it was, and I don't know what knuckleheads said to people and came up with this idea that you're going to be a lower tax bracket when you retire. We have people come in all the time. We had Steve and Debbie just come in. They were the retirees from the federal government, getting ready to retire from the federal government, way out in Bethesda. They actually work in DC, and they came into the office and they're having this conversation with us about, we always thought we were going to be in a lower tax bracket, but between our pensions and our Social Security and what we're taking out of our retirement accounts, we're going to be actually in a higher tax bracket. And I was like, Deb, Steve, you're exactly right. Most people that come into our office, it turns out you spend more money in the first 5 to 7 to 10 years of your retirement than you're going to spend in the rest of your retirement, because of the round to it list, the honey-do list, the bucket list, all those things. So anybody who thinks they're going to go into retirement needing less money, why? What exactly are you cutting out of your budget as you're going into retirement that is going to change dramatically enough that you can say, I'm going to be in a lesser tax bracket? Yes, you may have your house paid off. Maybe that's the change that you're going to have. But I would even argue then that that's not such a dramatic change as to necessarily put you in a lesser tax bracket. Maybe it is for some people, but certainly wasn't for Deb and Steve. I mean, that just wasn't the case for them. They recognized they were going to be in a higher tax bracket. And the reason why they called us in the first place was we were having this exact same conversation on the radio. And I was explaining how it drives me insane that nobody actually sits down and talks with people. I mean, the guys that are signed to the 401k, the TSP people, go ahead, call TSP, call OPM and ask for advice. It's impossible. It takes weeks and months to get your money out of the TSP to begin with. And God forbid you forget to dot an I or cross a T. You have to start the process over. It's just insane how much work. I mean, Deb and Steve were trying to do the same thing, and Debbie was the one driving that horse, and she was the one who was experiencing all these things because the TSP did not get, and really what it was is Steve had changed his email address and had never changed it with TSP. So when the TSP sent him the email to say, do you agree to let your wife take her money out of the TSP? It went to the wrong email address. Right. And to get it redone, they had to cancel the whole thing, wait 10 days to start the process over, then had to put in the new email address. It was just crazy. But the fact is that they recognized, one, they're not going to be in a lesser tax bracket, and two, Uncle Sam was going to take 30% of their RMDs, their required minimum distributions. Uncle Sam was going to take 30% of their federal benefits, and Uncle Sam was going to take basically 30% of their Social Security checks. So they were thinking to themselves, this is a really dumb way to go through retirement. And if you don't want to go through that part of retirement, if you don't think going through retirement, giving 30% to Uncle Sam, and quite frankly, whoever the governor of Maryland is, or whatever state you happen to be in, as you're listening to us, or I guess watching us, if you don't want that experience, if you want to try to minimize your taxes, if you want to try to achieve that platinum level, that gold level, that beautiful spot of 0% tax rates, sit down with Ryan, myself, and our team, and we will show you how to create income streams you will never outlive. We're going to talk to you about how much risk you're taking, the fees, and people in their minds, they say, the fees, I'm not paying much. Well, you know what? Taxes are a fee, so we're going to make sure you're paying the least amount of taxes possible.
Also online at thesavvyinvestorradio.com, thesavvyinvestorradio.com. Mike and the team at ProStatus have made it very easy for you. Very easy for you. Click on the tax analysis button at the front page there of the website, thesavvyinvestorradio.com, and that will put you to schedule a 15-minute phone conversation on your schedule, on your time. You have control of that. Again, that's thesavvyinvestorradio.com. Click on the tax analysis button. So we're talking about RMDs, taxes. And one of the things that you said to me, well, first of all, RMDs, required minimum distributions, that's either at 72, 73, or 75. Is that correct?
And actually the rules changed. And one of the advantages of working with a team that actually understands the rules and knows the rules is that we are always—
you keep up with them.
Yeah, we'll keep up with them, but we're always figuring out how do we work with the new rule changes, right? So they just recently changed it to 73. So for most people, if you weren't already doing RMDs start at age 73.
So what happens there? I'm required.
Right. Remember I mentioned that silent partner, the partner, the IRS, right? That they want their share. Yep. Well, when you turn 73, for our conversation, when you turn 73, they have what are called required minimum distributions. And what they want you to do is take out a percentage of your retirement account every year, no matter what, even if you don't need it, even if you're not going to use it, even if all you're going to do is take your percentage out, and it starts out around 4%-ish, and you have to take out that bit. And even if you're not going to use it, what they want you to do is take it out, pay taxes on it, and what they really hope you do is put it into another account that generates more taxes for them, because you're taking it out of an account that's tax deferred that you don't pay tax on until you use it, and you're putting it into an account that gets taxed every year. So your silent partner has said to you, put this money away. Don't worry about it today. We're going to give you a tax break to do it. And instead of taxing you on $1 today, what they want you to remember is that we didn't tax you on $1 today, but when it grew to $100, 30, 40, 50 years later, they want to tax you on that $100 later. So you think about that. You think about how smart Uncle Sam was in making that recommendation to you to take the tax break today, so that when RMDs, when they are forcing you to take money out, regardless if you need it or not, they're forcing you to take it. It's so they can collect tax dollars, and they want you to put it someplace else so they can collect more tax dollars as you generate more dividends and interest and whatever it's going to be. So it's a double whammy. It's a double insult. They kind of misled you, right? Because they didn't, they told you got a tax break, and they told you it'd be taxable later.
Yeah,
but they really didn't explain to you what that really meant. And, when you're 19, 20, 25 years old, you're just putting money away because you're supposed to. You're not really thinking about 30, 40 years from now, 50 years from now. Well, for us, and just myself as a prime example, understanding taxes, when I started this company back in 2002, we set up Roth 401ks, and we had Roths, and all our money has been going into Roth 401ks for my wife and myself and for my staff, because I understood I'd rather pay tax then than pay tax when I needed it later, because I can be tax efficient during retirement. And rather than have that silent partner who wants 20 to 30 to 40% of my revenue every single year, I don't have that partner in my life. And Deb and Steve, that's what they wanted. They didn't want a partner in their life. And most people coming into the office understand the importance of getting that person out of my life. And here's the, we said insult and injury. Here's the other part about it. Imagine this. All those advisors out there won't help you with the calculations because it's not my job. All those funds send you little pieces of paper throughout the year and say, by the way, you need to take some money out. And if you don't track them, if you're not paying attention, or if it's an annuity company and you think you can do this and it turns out that, all those numbers, if you forget to take money out, if you don't take out the right amount, and the IRS doesn't tell you how much to take out. What the IRS says is you didn't take out enough, and now we're going to penalize you. So not only are we going to charge you your tax, your 10, 20, 30, 40% taxes, we're going to charge you a 25% penalty because you didn't take it out on top of the taxes. So now we're talking about having a silent partner. And if you forgot, especially, think about this, mom and dad, as you get into your 70s and 80s and health issues become apparent, or, you have dementia issues, or just, floods, damages, all sorts of things happen to us as we get older, and you forget to take it out correctly, or you thought your advisor was going to do it for you, or because Fidelity sent you that statement and says, here's your RMD to your mind's eye, you said, oh, Fidelity's taking care of this, and you get money and you're not paying attention to that. Not only are you going to pay that 20, 30, 40% tax, you're going to pay 25% penalty. So all of a sudden we're 40, 50, 60% tax brackets. That's insane.